an asset shift between mutual funds and ETFs. How do asset managers pivot? A fund manager will explain. Plus, the entrepreneur is alive and well in America, and they're in cities you might not expect. We'll tell you where and more. This is 7 Day Yield.
Welcome to 7 Day Yield. I'm Lydia Moorish.
And I'm Mitch, Roschelle, and here's what's trending. This holiday season, it's digital or bust. According to the PwC 2016 Holiday Outlook, retailers anticipate a 25% increase in annual digital sales. It's thumbs a-tapping in a mobile wonderland. Digital sales growth is mostly fueled by mobile. This year, the report says we will see a big shift away from desktop towards mobile. From coupon searches to product store hour searches, mobile devices are playing a powerful role in shopping this holiday season.
By now, many of us have probably heard about the hype about driverless cars, but what does this mean for our insurance policies? While autonomous cars may reduce accidents up to 80%, it is unclear whether liability will remain with the car owner or if it'll shift to the manufacturer. But regardless of where we land on the litigation front, insurance agencies will still need to take into consideration existing and new risks, such as hacking, which could lead any driver out of luck.
Maybe I'm dating myself, but mobile phones have come a long way since the 5-pound Gordon Gecko variety that I probably had. These days, the latest craze is wearables. A recent study by PwC's Consumer Intelligence Series reveals that 45% of wearable buyers use the product for fitness. However, smart clothes and gaming devices are growing in consumer appeal.
The asset management industry is going through a tremendous period of change. From regulation to product evolution, Mitch recently sat down with a senior executive from BlackRock. Take a listen.
JP, we've talked a lot on 7 Day Yield about active and passive. So I was hoping you can break down sort of what's the latest trends and developments in the active world and the passive world.
Over the last 5 years, only 10% of active managers have outperformed the S&P 500. So clearly, investors have taken notice of that trend, and you've seen a mass movement into the passive space. And so we're fortunate at our firm to be able to have a very broad platform of both passive and active products. Importantly, we constructed the organization as well to have a very significant alternative fund offering. There will be moments in time where passive is really popular, like today, and then moments in time, hopefully, that active will come back and it to be more popular.
When I think about sort of an old school S&P 500 index fund, it's kind of alarming to think that most of the managers out there can't beat it. Is it because of the performance? Or are there other elements of a passive product that are just more desirable in the era that we're currently in?
Yeah, clearly, at the end of the day, clients still want value and are still willing to pay when performance on a net of fee basis is positive. That has not been the case, and therefore you see clients migrating. So I think it's the regulatory environment, the regulatory overlay, which in the United States, we've still got a few more years until the DOL rules really take shape, until they're really widely understood.
Until people read the 1,000 pages of the rule.
I think at this point, a lot of people have read the rules. Now the question is, how do you apply the rules in real life? And that is, you're seeing a wide array of interpretation, which imposes a pretty big burden on the asset manager who might have 25 distribution relationships to try to accommodate.
Another thing we've talked about a lot on the show is Robo Advice, and I wanted to figure out how in your world Robo Advice is playing a role and whether or not it has any impact on this toggling from active to passive.
It certainly is a trend that we see becoming more important. There is a large segment of the population that has investable wealth of between $10,000 and $100,000 that haven't historically been served by financial advisors. And so if you can construct a way through technology to deliver investment guidance and solutions to that array of clients, that's a terrific outcome for both the asset manager and the client base. And it could also be a solution in the post-DOL world, where typically Robo Advice is lower cost, and it's based on models that are designed, and it's not as much individualized investment solutions.
Real quickly, would you label Robo Advice a disruptor to your industry, or is it not ready to be a disruptor yet?
I don't think it's a disruptor yet. but I think you can't be naive. You have to take note of the millennial population, and the way that they think and invest will be very different than what a person who's in their 60s or 70s. So it's not yet a disruptor, but it's certainly a trend that has taken shape. We don't think it's going to just fly away in the night.
JP covered a lot of ground. To help us put this into perspective, Matt Haggerty, who leads the asset management research team here at PwC, joins us. Matt, we recently sort of boldly said that, if I get this right, there's going to see a shift from mutual funds to ETFs over the next 5 years of $6 trillion. That's a big number. Wow.
It's a big number, yeah. Considering, Mitch, that industry assets, according to the SEC, right now stand at $2 trillion. And a decade ago,
that's $4 trillion more.
$4 trillion
I did
more?
that in my head.
Yeah. When you think about that coming into play in 5 years, right, not only do asset managers have to defend their current client base, they also have to go after these new assets that have suddenly come into play, right? So we're seeing a lot of these conversations around how are you defending your client base and how are you also pivoting yourself to win in this new reality.
Mm-hmm. So talking about trying to get some of the newer customer base, obviously digital is really big, and we look at fintech and other disruptors happening in the industry. So is this sort of like the resurgence of the dot-com boom?
Yeah, I'd say it is akin to what we saw in the late 90s and early 2000s with the dot-com boom, when all of a sudden technology that was closed off to the masses and only available to a few, all of a sudden it became woven in the fabric of everyday life. And that's really what we're seeing, is this industry is pivoting to something that's personable, relatable, and accessible.
So tweeting at 3 a.m. and now looking at one's financial statements at 3 a.m. anytime, any place, that sort of thing?
It's an on-demand architecture, right? It went from a place where it was a face-to-face business, you're just talking to your advisor, to now all of a sudden it's, oh, I'm checking the news at 3 o'clock in the morning, or I just came across this tweet. I need to rebalance my portfolio now. I need to readjust my risk profile now. I need to get this taken care of now. So you're seeing a recurring theme, right? It's on demand and it's at whim and it's when I need it. It has to be done.
So obviously that works for the younger customer base, but how does that potentially negatively impact the older customer base that's perhaps used to, picking up the phone and speaking to their financial advisor?
I'd like to
Sorry.
Yeah.
Well, I mean,
I email my financial advisor, and then they tell me that they can't do the transaction because it has to be over the telephone.
Well, you also tell me you can't handle Google Docs, so maybe.
There you go. There you go.
But I mean, how should companies be thinking about sort of the dual business model?
Right, and I think a lot of it is striking a balance. How, as an asset manager, can you accommodate these younger generations who just want to keep you as the advisor at arm's length, versus what your customers have essentially grown up doing with the white glove service, the high touch model. So a lot of it is slowly introduce them to more on-demand, more online services and that sort of thing.
Great, well thank you so much, Matt.
Thank you both,
Very
glad to be here.
insightful.
Yeah, awesome.
After the break, we'll be speaking live with an entrepreneur who's made it his mission to revitalize American cities and communities. We'll be right back.
Are you following her? Did you see the new kicks she just posted? I'm gonna get them.
Show me the deals.
I could really use some new boots this season.
Done.
Free shipping? Awesome.
And purchase.
So easy.
Welcome back to 7-Day Yield. Many decades ago, cities like Detroit, Cleveland, and Baltimore were hubs of innovation and technology, where entrepreneurs were starting new businesses and innovating. Our next guest, Andrew Yang, CEO and founder of Venture for America, has dedicated his life to returning the entrepreneurial spirit to cities that are in much need of economic revitalization. Andrew is here live in Studio C. Welcome.
Oh, it's great to be here. Thanks for having me.
So explain sort of what caused you to, sort of be a law student and then one day decide to start a not-for-profit trying to change the world.
Well, there was a lot of time between those two things. I graduated from law school, became a lawyer for a little bit, found it wasn't a great fit, and then I started a business in the first dot-com boom. And that business did not work out. So I joined a more experienced entrepreneur, worked for him for a number of years, and then became the head of a company that was then acquired by the Washington Post in 2009. So during that decade or so, I realized that the way I learned and developed, which was by working with a more experienced entrepreneur, was something that we could apply to communities around the country, and that's what we hope to do with Venture for America.
So I heard that President Obama read your book, which I would equate the equivalent of being part of
There's the
Oprah's
book.
book club. So tell me, how did that help put you on the map?
I was named Presidential Ambassador of Global Entrepreneurship last year. And so it was a lot of fun being back in the White House with President Obama. And I'm happy to say that he understands Venture for America, asked questions that let me know he's thinking about it for his daughters down the road.
So, in full disclosure, I'm on the board of Venture for America, but if you think about the cities that you picked, sort of why Detroit? And Detroit was a place where startups were taking place, and sort of that went away and it's back, but you're sort of bringing startups back to Detroit. Maybe you explain that a little bit.
I was just in Detroit last week, and even though there are many challenges there are tremendous opportunities as well. We've now driven about 70 talented, aspiring entrepreneurs to Detroit. They're doing things like buying houses on the cheap, rehabilitating them, and renting them to local tenants and other Venture for America fellows. A couple have started businesses that have already gone on to employ dozens of people in Michigan and beyond. One of them is already generating over $1 million in revenue and is off to the races. So we've seen what's possible when you bring talent into environments that enable them really a ton of upside and growth with very low costs.
But for some reason, kids graduating from college didn't want to become entrepreneurs, and maybe that's almost a half a generation. And why do you think that happened, that they wanted to get sort of more traditional jobs and not be entrepreneurs? Did we lose our way sort of as a country in terms of entrepreneurial spirit?
If you look at the reasons why fewer young people are starting businesses, one big culprit is education debt. It's up to over $37K on average for a college graduate. And so that ends up applying really not just to 22-year-olds, but it applies to the choices they make when they're 25, 28. Home ownership is later. Home ownership is actually correlated to entrepreneurship because it's one of the first places that someone goes for that first source of capital. So the trends nationally are not great for entrepreneurship in terms of people under the age of 30, and we're hoping to reverse that with PwC's help. As Mitch mentioned, Mitch and I have been working on this for a number of years, and we love PwC. We're so grateful for all of the incredible support that we've gotten over the years.
Is it things like crowdfunding that can help people feel that maybe it's less risky for them to start their own companies?
Crowdfunding is a great positive in this space, but if you look at how entrepreneurs get their money, the two first sources of capital still are their own money and friends and family. If you look at it, it's over 80% are going to be from one of those two sources as the first step. And so crowdfunding can help with that. Crowdfunding can reduce those proportions somewhat and make that first 10, 20, 30,000 more accessible. Mm-hmm. We're really excited about the advent of crowdfunding. I know you guys had Charles Best on another episode. And, it's democratizing access to capital in a great way.
Mm-hmm. So until we can lower student loans, we may not see younger people sort of entering this space earlier.
Well, one thing we've seen with Venture for America is that great things are possible when you give them resources, support, and mentorship. Mm-hmm. One thing I tell people is that if you take a young person and put them in a big company, then they'll look at their manager and say, that's what I want to be. If you put them next to an entrepreneur in Detroit, they'll look at that entrepreneur and say, that's what I want to be. So we've seen great results with Venture for America, where over 20% of our fellows have gone on to start a business by the time they graduate from the program. Mm-hmm. And so we think that we can really encourage entrepreneurship structurally if we just invest in it. One joke I tell is that if you're a 22-year-old and you want to get a law degree, the government will give you a $100,000 loan, no questions asked, and your parents will think it's a great idea. And if you want to be an entrepreneur, no one's going to give you a $100,000 loan, and your parents will generally think it's a not great idea. Mm-hmm. So you can see that we're encouraging some things very strongly, and we need to encourage entrepreneurship in the same ways.
Excellent. That is a tough act to follow. I'm just going to have to end the episode sort of right on that. So, Andrew, thanks a million for joining us, and happy holidays.
Thank you, guys, and thank you, PwC. Love you guys.
All right. Thanks. So on our next episode, we are going to do a year-end wrap-up. So thanks for joining us.
Thanks for watching. To catch up on previous episodes, be sure to check out our PwC YouTube page. Plus, you can follow us on the Twitter handle below. We'll see you next time on 7-Day Yield.